Chapter 4: The Mechanics of Gold Market Manipulation. In this chapter, the key essential information is revealed about the schemes that could be used to suppress the price of gold. The basic concept you have to grasp in order to understand the schemes of manipulating the price of gold is the concept of supply and demand. Supply and demand is perhaps one of the most fundamental concepts of economics and is the backbone of a market economy. Demand refers to how much of a product or service is desired by buyers at a certain price. Supply, on the other hand, represents how much the market can offer this product at a certain price. The law of demand states that if other factors remain equal, the higher the price of a good, the less people will demand that good. The law of supply, on the other hand, states that the higher the price of a good, the more people will be willing to supply by selling the good. When supply and demand are equal, the economy is said to be at equilibrium. At this point, the allocation of goods is at its most efficient. When supply is larger than demand, prices must come down in order to re-establish the balance between supply and demand. So when there is less supply than demand, prices will go up, and when the supply is larger than the demand, prices must come down. So when gold prices go up, the demand for gold exceeds the supply. Now have a look at this supply and demand chart. It shows the amount of gold mined each year relative to the market demand for gold each year. As you can see, for years now there is less gold mined than there is demand in the market for extra gold. The question is, where does all this extra gold come from? The answer, according to the World Gold Council, is recycled scrap gold and supply by central banks. In the recent months, you might have noticed commercials from Cash for Gold on US television or Briefgold on German TV. These companies buy scrap gold, refine it and then sell it to the market. For the last couple of years, China also has become a big buyer of scrap gold. China wants to buy as much gold as possible without creating a surge of the spot price of gold. So it accumulates gold outside of the marketplace, buying scrap gold. As the spot price of gold has indicated over the last decade, there has been trouble cancelling out the demand for gold on the market by supplying the yellow metal. And since central banks issuing fiat currencies around the world have an incentive to keep the price of gold down, they need to intervene in the gold market in order to prevent gold prices from exploding. So now I will demonstrate the mechanisms that central banks, in collaboration with other participants, could use to suppress the price of gold. The sales, as mentioned under number 1, are legit when the proper governmental agencies have decided to sell a part of the nation's gold using the correct procedures. They nevertheless have a negative effect on the price of gold, and even when in reality no central bank gold actually hits the market, the price of gold can be affected on a negative way, as we will see in the first part of the following video. The practices of leasing gold mentioned under the number 2 are a lot shadier and are essential to understand. Then under number 3 we have the classic scheme of fractional reserve management, which we owe our current money and banking system to as well. And the sales of gold derivatives mentioned under the number 4 that are not 100% backed by physical gold are the holy grail to maintaining the gold price suppression scheme over time. Then, in more recent years, some Wall Street power brokers have invented a new way of front-running the market using supercomputers and algorithm trading. At the end of the chapter, we will have a closer look at this clever front-running scheme that is mentioned under the number 5 on this slide. So, here you have the complete overview of the methods that could be used to suppress the price of gold. In the next videos we'll have a closer look at each one of them.